I'm joined by Gaurav Sharma, the oil analyst and business editor for IB Times UK. Gaurav, thanks very much for joining us today. Tell us a little bit about yourself and your background.
I have been covering the oil markets for better part of 12 years now. I started out covering macroeconomics, started out with the Newswire, then switched on to some B2B publications before oil came on my radar in 2004. And the idea of covering oil markets somehow took hold from there. It fascinated me how various sectors of the global economy were so dependent on oil, and just sort of went on from there. And by the time I reached up to, we were in 2009, I stopped the day job, meant that I was more and more into economics than the oil markets. And I was so fascinated by it that I started writing a blog on oil markets. So I've almost always kept in touch with that. And of course, then back in 2012, the oil world came back into my focus and sort of went on from there.
Let's talk about the energy markets. How have they changed since you started, so in the last 10 years or so?
Well, very different. In sort of last decade, we've seen highs and lows of various descriptions. We've seen the oil price soar to $147, then fall back to $37. And more recently, earlier this year, we had oil falling all the way back to $27. There's been extreme volatility, but it makes for exciting times.
What could you tell us about the current oil supply demands?
There seems to be a fair bit of market imbalance, or rather, let's say there's a perception of imbalance, that you have various parties, various stakeholders in the global oil markets who are kind of convinced that oil is going one way or another, and it defies all logic. Each time we think that there's going to be some market balancing, exactly the opposite happens. Each time there's a viewpoint that we're going in a particular direction, some event or the other almost always comes as a factor. Now, looking back at sort of the last 10 years, geopolitics has been a very big factor in the oil markets. But let's say towards the turn of, say, 2013, 2014, we were looking at somewhere around $10 of what us analysts like to rather colorfully describe as the geopolitical premium or the risk premium, whatever acronym you want to go by. And after 2013, when more and more US shale oil started coming onto the market and places like the North Sea, etc., started ramping up some of their production, this geopolitical risk premium, as it was known, turned into risk fatigue. So you had traders telling you, oh, well, you know what, we factored that $10 premium in the oil price, and now suddenly there's just so much oil, so that's practically negligible. And that is where the tide turned. I turned my memory back. We look at June 2014. Oil was at somewhere around $115 a barrel, and there was really no need. It was thoroughly unmerited. There was so much oil coming on stream, and suddenly the market started in decline. Went to a bit of a decline from there. From 115, we were in 90. 80, 70, and then earlier in January 2016, we were down at $27. So it's a remarkable slide.
Is global demand for oil still increasing?
See, the Chinese always led the market in terms of demand. It is right now, with the US domestic production being pretty much on song, the US has slowly retreated from the global oil markets because it has so much of its own oil. The Chinese production was always what kept the market going. We look back at the global financial crisis, the one reason that oil slowly started creeping up to $100 after the financial crisis was because Chinese demand was buoyed by their own internal stimulus. Now, as where we sit in 2016, Chinese demand is nothing like it was in 2012, 2013. It's holding firm, it's more or less stable year on year, and that's going to have a domino effect. One thing is that how much the Chinese are importing. The other thing is the market perception. If the wider market believes that the Chinese are not going to import as much as they used to, which is true, they aren't. It's rather flatlining, it's not growing year on year. And if the market is convinced that the Chinese are not growing, then they try to factor in other countries, other importers into their forecast. And the only obvious one that they see is India. And now, of the big five consumers, which would be China, the US, India, Japan, and South Korea, the biggest consumers, Japanese demand is in decline. South Korean demand is not quite firing up. Chinese demand, as we discussed, is just flatlining, and the US is not turning to the global market as much. So everybody is looking at India. But in India's case, the demand is more towards lower distillates, not sort of the high end. That's where the demand is firing up. But nonetheless, just banking on one major importer to look at demand scenarios is not really very clever thinking, which is why the market seems to think that demand and supplies is more or less evening out, and if more and more barrels come onto the market, the price goes lower.
So do you think there is potentially more supply than demand?
See, that is a tricky one. There could be an artificial intervention by OPEC, and they have tried it in the past, where OPEC has been quite successful piggybacking on the Saudis as the swing producers. In a classic sense, in a global sense, the Saudis are still regardless of whatever you hear elsewhere in the markets, the Americans are not the swing producers, they're buffer producers. The Saudis, in a classic sense, remain the only global swing producers. Now, the reason it's not quite working out so well for OPEC, especially let's say in the last 3 to 4 financial years, is that the role of a swing producer that the Saudis have, well, they can unilaterally decide to, we'll take maybe 1 million barrels per day out of the market. But what's to say that will not support the American industry, who would just step into the breach, especially now that the United States can export oil by law. They weren't permitted to earlier, but now they are. All additional barrels from elsewhere would just come into step into the breach and eat into the Saudi or OPEC or Middle Eastern oil market share, and they're scared of that. Which is why I would say incremental barrels are here. The US oil production, it's down by about 1 million barrels per day. If OPEC decides to cut another 1.5 million, then I think that will support the price. But right now, the way I see it, and this has been the case for the last 12 months, or I would say rather the last 18 months, is that there's more oil than we need.